Have you ever stopped to think about where money actually comes from? I mean, really think about it. Well, the answer is probably not what you're expecting, and honestly, it's way more fascinating. Today, we're going to pull back the curtain and see how money is really made.
So let's just start with that big question. When you picture money being made, you probably imagine these giant printing presses, churning out stacks of crisp bills. And yeah, that happens, but it's not even close to the whole story.
The truth is, the vast majority of money in our economy isn't printed at all. It's created, almost like magic, out of thin air, every single day by an institution you deal with all the time. Okay, let's get into it.
But first things first, to really get how money is created, we kind of have to agree on what money even is. And to do that, you have to go way back to see what problem money was trying to solve in the first place.
Before money, you had barter, and honestly, it was a total pain. You had to find someone who not only has the thing you want, but also wants the exact thing you have. Economists call this a double coincidence of wants. It's super inefficient. Money fixes all that. It's the go-between, the universal thing that everybody agrees has value.
So, for economists, the definition of money is actually pretty broad. It's not just the cash in your wallet. It's basically any asset that we as a society are all willing to accept as payment. That shared agreement, that collective trust, that's the magic ingredient right there. And that accepted asset has taken a few different forms over the years. You've had commodity money, things like gold or beaver pelts back in the day, stuff that has its own value. But the money we use today, that's called fiat money. Its value comes purely from our collective faith and the fact that the government says, yep, this is money. It's not backed by a pile of gold somewhere.
Now you can get lost in all the complex definitions like M1, M2, but let's just cut through all that. For our purposes, when we talk about money, we mean two simple things: the physical cash out there and, way more importantly, those digital numbers you see in your bank account.
All right, now for the main event. This is the big reveal. This is where the real magic happens. It's not some government mint working overtime. Nope. The primary engines of money creation are just your ordinary, everyday commercial banks.
Let's walk through a quick example. Imagine you get a $1,000 tax refund, and you pop it into your checking account. Now, you might think that money just sits in a little pile with your name on it, waiting for you. It absolutely does not. Okay, so from the bank's point of view, your $1,000 shows up on both sides of its books. It's an asset. That's $1,000 in cash they can now use. But it's also a liability, because they owe that $1,000 back to you. Now, at this point, no new money has been created. Yet, the cash just moved from your pocket to the bank's vault.
And this is where it gets really interesting. There's this thing called the reserve ratio. See, banks are making a bet that we're not all going to show up and demand all our money back at the exact same time. So they only keep a small fraction of it on hand. Let's just say it's 10%. And the rest? They loan it out to make a profit.
So here's the crucial part. Your bank keeps $100 of your deposit, and it loans out the other $900 to someone who wants to buy, say, a new laptop. That person pays the laptop store, and the store deposits that $900 into its bank account. And just like that, bam, $900 of brand new money has just been created. Your account still says $1,000, and the store's account now says $900. But it doesn't stop there. The second bank keeps 10% of that, $90, and loans out the other $810, and this just keeps going and going and going.
So how much money can actually be created from your one single $1,000 deposit? When you do all the math, with all those loans rippling through the system at a 10% reserve ratio, the grand total is a staggering $10,000. Your deposit just got multiplied 10 times over.
And yeah, this quote here really just nails it. Every single time a bank makes a new loan, it creates a new deposit somewhere else, and the total amount of money in the economy just gets bigger.
So if you think of all these commercial banks as an orchestra, playing their instruments and creating all this money, it kind of begs the question, who's the conductor? Who's making sure this whole symphony doesn't just spiral into chaos? I mean, this whole system, which we call fractional reserve banking, has a pretty obvious risk built into it. The money isn't all there in the vault. So what would happen if some kind of panic set in and everybody rushed to the bank to withdraw their funds at the exact same time?
Well, that nightmare scenario is called a bank run, and it's the kind of thing that can bring a whole financial system to its knees. And that's exactly why countries have a central bank. For us, that's the Bank of Canada.
So the Bank of Canada, created way back in 1934, has two really critical jobs. First, it's the lender of last resort.
If a perfectly healthy bank gets hit with a sudden run, the central bank steps in with emergency loans to calm everyone down. And its other huge job is to manage the overall money supply, using its tools to keep the economy from getting too hot or too cold.
Okay, so banks create money, the central bank is the referee. Big deal, right? Well, yeah, it's a huge deal, because the total amount of money sloshing around in the economy directly affects the value of every single dollar in your pocket.
And this brings us to this famous idea called the quantity theory of money. Now, I know the equation might look a little scary, but the core idea behind it is actually incredibly simple. It basically draws a straight line between the amount of money in an economy, M, and the general level of prices, P.
Let's just boil it all down to the simple takeaway. If the amount of money grows way faster than the amount of actual stuff, goods and services being produced, you've got way more money chasing the same amount of stuff. And what happens then? Prices have to go up. That's inflation 101.
And if you want a truly terrifying real-world example of this, you just have to look at Germany after World War I. The government went on a printing spree to pay its debts. The money supply exploded, and just like the theory says, prices went right along with it. By 1923, the price level was 126 trillion times higher. Your life savings could barely buy a loaf of bread. That's the danger we're talking about.
So when you boil it all down, most of the money we use isn't physical cash at all. It's just a series of digital entries in a bank's ledger. A system built entirely on trust and expanded through loans. Which leaves us with one last, really fascinating question. If money is just a trusted entry in a ledger, what does that mean for the future of money?